Hello, finance friends. In this lecture, lecture 4 in our series, we're going to be discussing one of the most important purchases that you'll likely make in your life. That is the home purchase. And tied to that, we'll be discussing mortgages. A mortgage, as you might know, is a loan that you take out in order to buy a house. In a previous lecture, we actually covered different types of loans, including amortized loans, which we also called the installment simple interest loan. So we already have a basis for how mortgages work, but we'll go into a bit more detail. Let's jump in. So your financial life is ultimately going to be a series of decisions. You'll have to make lots and lots of decisions. We've discussed some of them already. Will you be a capitalist or a consumer? Will you save money or will you live above your means? When it comes to all your decisions, however, there's a very good chance that your housing decision, the decision that you make on if and when to buy a home, will be among the biggest, the most stressful, the biggest financially, and one of the most important decisions that you're going to make. So it's worth putting some time into. The house decision is also very important because ultimately your decision to buy a house is going to have an impact on lots of other aspects of your financial planning. So a lot of other elements in your plan are going to be influenced based on your housing decision. You're going to have, for example, an impact on your savings and your cash flow. If you decide to buy a house and you start saving for a down payment, that's going to take a lot of money from other expenditures as you set it aside. When you buy your house, you're going to need to have cash flow to cover all your expenses. You're going to have to learn how to save to prepare for everything from, again, the down payment to setting aside money, because ultimately, if you buy a house, houses are complex systems, so you're going to have to do repairs. So it's going to affect your cash flow and your savings. Obviously, insurance. We know we have 4 buckets, and the 4th bucket is protecting your wealth and protecting your assets. You're going to need to buy insurance for your property. It's going to affect tax planning. We haven't covered income taxes yet, but when we cover income taxes, we're going to learn that there's a few tax benefits that homeowners can receive that are not available to renters. So there might be some positive tax benefits, and that's going to affect your tax planning. Retirement will be impacted. It's not obvious why, but if you think about it, if you buy a home, there's a good chance that by the time you reach retirement, you'll have that home paid off or very close to paid off. And this means that you can think about retirement differently. If you have a home that's almost paid off, you can expect in your retirement, your housing expenses to fall because you wouldn't be paying rent or paying mortgage. At the same time, you'll have other expenses too, but it will definitely affect your retirement. It will also affect your retirement because it is possible through a tool called, actually, let me redo this again. It's possible through a tool called a reverse mortgage to use your home's equity as a source of liquidity in your retirement. So there's some benefits when you retire to having a paid off home. And finally, estate planning, which is where you plan out where your assets go after you die, that's going to be impacted too. Because if you have a home and there's significant equity in it, or it's even paid off when you die, you're going to have done some thinking about who's going to get that asset after you're gone. So it's a really big decision. It's going to permeate a lot of other aspects of your life. And that's why, like all financial decisions, but especially in this case, when you're thinking about major purchases, and especially about a home, you really have to follow a systematic and structured way of thinking. There's going to be emotion in there, of course, because buying a home is an emotional thing. And it's a, you think of all the money that's going to be spent on it. And, if you're going to have a family or things like that, you can raise a family. So there's clearly emotional aspects. But you've really got to, before the emotion kicks in, really have a very structured, linear, organized way, a systematic way of thinking about this decision. In that decision, one of the very first questions that you have to ask is, do I even want to buy a home? The reality is, while many people say or they assume that owning a home is part of the American dream, it's not for everybody. And in fact, many people prefer to rent as opposed to buy. There are some people who buy and should have rented. So in all the decisions that you're going to have to make, the very first one is home ownership even for me? Or should I actually rent? There's a few things that you can sort of think about, a few parameters that can guide you into this. One of the first parameters is to think, let me get this back to pen, is to think about your cash flow. I want you to imagine a person who rents. You can rent an apartment, you can rent a home, you can rent a condo. So renting does not have to mean just an apartment. You can rent, a home. So think about a person who's renting and making a payment to their landlord, and think about another person who owns the home and is, making payments through their mortgage to the bank. If you think about this, renters have a bit of an advantage, at least in cash flow. Because from one lens, if you're a renter, your monthly rent, that's the most that you're going to have to pay for your living expenses. Now, I mean, there'll obviously be utilities, which are small, and your renter's insurance. But in terms of your big expenses, if you're a renter, your rent payment is the upper limit that you'll have to pay. If there's issues with the property, if there's, the property taxes, big repairs, those are not your responsibility as a renter. Those go to the landlord. So it's important to think that if you rent, your rent payment every month is basically the maximum housing payment, the maximum housing expense you're going to have to make. Again, utilities, small things like that accepted. On the other hand, let's go back to the owner. The person who owns a home and is making a mortgage payment, that monthly mortgage is the minimum that they're going to have to pay. You're going to have to pay the mortgage, but also property taxes, insurance, all your utilities, upkeep. Homes can be very expensive propositions. So it's well worth thinking about in terms of your cash flow and your balance sheet numbers. For a renter, the rent is the maximum that they'll have to pay. For an owner, the mortgage is the minimum. The big thing that I want you to keep in mind, though, is when you're talking about renting versus buying, and when you're talking about home ownership in general, you really want to focus on an idea that I call TCO, the total cost of ownership. TCO thinking should be a part of your financial toolkit for all your big purchases. So for example, if you're going to buy a car, you should not be thinking, oh, the car costs $35,000. That's the cost of the car. You should always be thinking about the total cost of ownership. How much will the car cost? How much will insurance be? How much will upkeep, maintenance, gas, repairs? You really need to think about the total cost of ownership, because if you think about the total cost of ownership correctly, then you're well positioned to really be thinking about opportunity cost correctly. So I want you to be thinking about home ownership from the total cost of ownership, not just the mortgage payment, but the total cost of ownership. And in a moment, we're going to break this down into a few categories. Lots of people, lots of financial experts have different views, but one of the consensus views is that for the average person, renting is generally going to be less expensive in the short term. However, when you think about both the appreciation of the home in value over time, as well as some of the tax savings, the consensus seems to be that while renting is generally less expensive in the short term, ownership tends to be a better bet in the long term. Of course, you're going to have to think about this from your own unique situation, factoring in your own goals, your own phase of your life cycle, what you want to achieve, your cash flow, where you want to live, and everything else. A tool that you might want to take advantage of is a rent versus buy calculator. There's lots of them online. They're all free. Most are very good. You can just do a search for rent versus buy. And what those will do, rent versus buy calculators, you just plug in variables based on if you're in an apartment now, for example, what your rent is, and if you're looking at a home, what your home is. You just plug in these variables, and these calculators help you do some of the deeper analysis that helps make sense of the numbers for you. So always look at a rent versus buy calculator as you're making the decision, that first big decision, should I actually rent? Should I actually rent or should I buy? Okay. Now, many people are excited to buy homes and they want to do it. They look forward to doing it as a part of their plan. I would offer to you that in terms of your decisions, you really need to think hard about buying a home in general, and you need to be especially critical in your thinking if you cannot achieve a few key metrics. In other words, you really may not have, at least at this moment, you may not have any business buying a home if you cannot do 4 things. Number one, if you're currently living net cash flow negative, if you're living above your means as it is right now, home ownership is not for you. You really should not consider buying a home unless you're already able to afford your current lifestyle and consistently run net cash flow positive, because a home's only going to be more expensive. You also should only consider buying a home if you have the capital to put 20% of the home's purchase price down. We'll talk about down payments in a moment, and there's lots of different views on down payments. Some banks will give you mortgages with very low or sometimes even no down payment, but the historical rule was you want to put down 20% of the home's purchase price by way of down payment. So hypothetically, if you were looking at a home that was going to cost $100,000, you should be putting 20% or $20,000 down payments, a cash payment you make when you buy the home, and then the other $80,000, that is what you mortgage. Again, some of these rules are becoming a little, to some people, outdated, but I still think it's a good idea. You should really be thinking critically if you don't have enough money to put down 20%. You should not buy a home if you cannot manage the full TCO. We're not just talking here about the mortgage payment. We're talking about all of the other expenses, some big, some small, some obvious, some hidden, that contribute to the total cost of owning a home. And you really need to think deeply about buying a home if you cannot commit to staying in that home for at least 10 years. The reason for this is because most financial professionals encourage you to think about homeownership as a long-term proposition. But remember this too, you're going to have to pay seller fees, both when you buy a home, or we'll call them commission fees, when you buy a home and when you sell a home. Those commission fees can range from 2 up to 6%. So if you think about it, if you buy a home and then you're losing 6% or you're paying 6% in addition on commissions, and then when you later sell the home, you're going to lose 6% on commissions, you need to own that home for a long enough period of time that the house appreciates enough to cover both of those commissions and still leave you a bit of a profit when you sell it. And that might take some time. So there are some general rules. When we talk about TCO, the easiest way to think about it when it comes to a home, in other words, we're answering the question here, what does it actually cost to buy a home? I want you to think about 3 broad categories. The best way for me to understand the cost of home ownership is to think about the 3 broad categories of home expenses. Category number 1 are upfront costs. These are the costs that you must pay in cash when you actually buy. Technically, They would say when you actually close, those are your closing costs. Closing meaning when you finally sign the legal documents and you take possession of the keys and the house is now yours. You're going to have to put some money up front. In addition, once you own the home, you're going to have ongoing costs every month. And they're going to be predictable monthly costs. You have to be able to cover those. And then the third category of TCO, the total cost of home ownership, are the ongoing costs that are less predictable. Maintenance costs, repair costs, these things that just happen because homes are complex systems. So don't just think about, oh, I can afford that mortgage. You have to think, can I afford the upfront costs? Can I afford the ongoing, predictable, expected costs, including the mortgage and the property taxes? And do I have enough cash flow to cover the less predictable, but certainly inevitable costs that go with homeownership, like maintenance? Let's break these down one by one just to get a little bit more detail. When it comes to upfront costs, there's going to be a couple that you need to consider. The most obvious one, your down payment. We had said earlier that you should strive to put about 20% of your home's purchase price down in cash as a down payment. In addition to the down payment, you're going to need to cover some what we call closing costs. Closing costs, they typically range from about 3 to 7% of the mortgage amount. And these costs cover a wide array of really miscellaneous expenses, everything from attorney fees, title fees, search fees, home inspection fees, appraisal fees, your notary fees. There's lots of little fees that by themselves may not be a lot, but collectively they add up to a chunk. Typically 3 to 7% of the home's mortgage amount. And you're going to have to cover those in cash when you buy the house. So we're talking about 20% needed as a down payment, maybe an additional 3, 4, maybe 6, 7% on top of that for the closing costs. So you're already looking at a pretty decent cash outlay as you're looking to close the home and actually take possession of the keys and buy it. There's a potential, not necessarily there for all of you, but a potential third upfront cost. And this is a unique concept in homeownership called points. Okay, we'll get into points a little bit later, but for now, let's just say that a point represents a fee equaling 1% of the total loan amount. So let's say again that you were going to buy a home for $100,000. You're going to put 20% down. So you're going to mortgage 80%. And 80% of 100,000 is going to be 80,000. So you're going to take out a mortgage for $80,000. You have the option with most mortgage lenders of what we call buying points. A point equals 1% of the mortgage amount. So on an $80,000 mortgage, 1% would be 1% of 80,000 or $800. If you buy 1 point, then in addition to your down payment and your closing costs, you're also going to put down that 1% of the mortgage price. Now you're asking, well, why would I possibly pay even more money? And here's the answer. Points, if you buy the points up front, you lower your mortgage interest rate. So if you were to go right now onto any bank website or any kind of lending or home website, you would see a whole list of mortgages from different lenders. And what you would also notice is with many lenders, they would have a mortgage rate with no points. And then they will give you a list of points and then the corresponding interest rate there. And what you will find is if you buy more points, your mortgage rate goes lower. And if your mortgage rate goes lower, then your interest payment every month and your house payment every month goes lower as well. So you can think of points as a way to pay money up front right now to lower your interest rate and have lower payments in the future. So there's a bit of a money trade-off there. Big idea then, so these are your upfront costs. The big idea here, these upfront costs have to be paid in cash at the closing meeting when you take possession of the house. Big question you're going to have to answer. How are you going to cover those? How are you going to cover those upfront costs? For most people, it's going to be by having made a plan years earlier and starting to save money aggressively every month to slowly but steadily build up that down payment and that closing cost money, so they have a bit of a nest egg, right? You know, a bunch of cash in the bank that they can then deploy to cover those closing costs. So that's our first type of cost, upfront. The second type of cost in owning a home are going to be the monthly costs that are predictable. And we call this the pity. If you buy a home, you're going to have to pay every month the pity. What is the pity? Well, every month, the predictable monthly cost that you'll have as a homeowner are going to include, remember, you're going to take out a mortgage, right? You're going to take out a mortgage. The mortgage is a loan. And as we learned in a previous lecture, when you take out a loan, you have to pay back both the principal, the amount that you borrowed, and the interest. The interest is the price you had to pay to borrow that money. So every month you're going to make a mortgage payment. And that mortgage payment every month will cover both the principal and interest components for that loan. So every month you're going to have to pay principal repayment and interest payment on that loan. Again, principal and interest are wrapped up together in your mortgage payment, and that's your P and your I. In addition, you're going to have to pay property taxes. Property taxes are generally assessed by the county where your home is located. So you can actually, depending on where you want to live, you can just look up the name of that county and do a quick search. Property tax rates for Los Angeles County, property tax rates for Orange County, wherever you want to live, and it will give you the percentage. That percentage applies to your purchase price of the home, the assessed value of the home, and that's your property tax annually. And then you can make that into monthly segments, and that's your taxes, that's your T. And in addition, because you're spending so much money on this thing, you have to insure it. So you're going to need homeowners insurance. So every month you're going to be paying at minimum principal, interest, taxes, and insurance. That, my friends, is your pity. It's going to typically be the same every month. Now, those are the big four. In addition, you might have one or two other predictable monthly expenses based on your own particular situation. If you decide to live in a condo, so instead of buying a single family home, you buy a unit in a condominium complex, the condominium complex will also assess you what is known as a homeowner association or an HOA fee. HOA fees are, again, they're in addition to your pity. The HOA fees are paid to the condominium homeowners association, and those payments every month be from you and all the other condo owner HOA fees, those are pooled together in a big pot, and that money goes to repair or upgrade the common areas in a condo complex. If you buy a condo, you're partially responsible for the upkeep of the whole complex, not just your own unit. HOA fees cover that. And if you decide that you're not going to put down 20%, so if you put down less than 20%, your lender is going to judge you as slightly riskier, and they're going to charge you extra money to cover what's called PMI, private mortgage insurance. So again, PMI, private mortgage insurance, this is insurance that you have to pay for if you don't put down 20%. So every month then, to conclude this slide, you're going to be on the hook as a homeowner for at least the PITI and maybe even HOA and maybe even PMI. All of those you're going to have to cover every month for as long as you own the home. That's that second category. And then your third category are, I put here monthly, but they don't have to be monthly, but these are going to be all the other expenses. So up here, these were predictable. Here we're talking about the less predictable expenses that are still inevitable. So I put them as monthly because even if you don't have a monthly expense, you're going to need to save money every month for the inevitable day when you have to make these payments. And this is primarily maintenance and upkeep. The reality is homes are complex structures. They're made up of many different types of systems. And those systems, like all systems, are going to break. They're going to be, you're going to be required to maintain them, keep them looking good, and when they collapse, fix and repair them. So this maintenance, and we can also add to that, I suppose, repairs, these are also a part of homeownership, and they can be a really expensive part. We're talking here about, for example, utilities, sanitation. We're talking here about landscaping and home aesthetics, but the real big thing, we're talking about our internal systems. I put a slide right here. This is a list of some of the things that you would have an inspector look at when you go to buy a home. So if you say, I'm going to buy a home, I want to look at this home, you're going to bring an inspector in, and that inspector is going to look at that home and let you know if there's any warning signs. This is just a partial checklist of what an inspector would look at when they do their job. And I put this up here just so that you can see all of the different elements, external, internal, plumbing, flooring, heating, HVAC, heating is HVAC, electrical, outdoor buildings, all your systems. I mean, houses have lots of complex systems within them. Any one of those can have issues at any time. So I put this checklist here just so that you can see a sample of the many systems that will make up your home. And this should open your eyes to just how complex a home is as a structure and just how much potential maintenance and repair cost you might be on the hook for. Now, there is a way that you can prepare for this. These are called sinking funds. A sinking fund is basically, it's an account. And every month you put a little bit of money into it. So let's assume, I'll make this very easy. Let's assume that you think that on average, you're going to have to spend $2,400 a year on upkeep and maintenance and repair work. I'll just make this number because it's easy. You're not going to have this every month necessarily. Hell, you might not even have to make any repairs or big upkeeps or big maintenance upkeep things for many years. But you say it's going to average about $2,400 a year. So what you would do, $2,400 a year is basically $200 a month. You would basically consider $200 a month in additional home ownership expense. And then every month you would put $200 into your sinking fund. And every month, as you put money in, the balance of that fund will go up. And then you'll have a pool of liquidity because when you have something you have to fix or repair, then you use the balance in your fund and you pay it off. Now that, of course, drops your balance back down, and then you keep contributing every month. So you're making monthly contributions so that you have a pool of money. So when you have to make infrequent and unpredictable expenses, it's all there for you. So that's called sinking funds. Whether you use it or not, though, just know you're going to be on the hook for other costs. Okay. Together, all of these, your upfront costs, your PITI, and all of your less predictable repair, maintenance, and upkeep expenses, this is a much more accurate way of thinking about your home's TCO. Okay? So, a lot of decisions already. Here's another decision. Once you decide that you're going to buy a home and you say, I've done the numbers, I know how much mortgage, I know that I can afford a mortgage, I know I can afford the points and the closing costs and the down payment, and I'm going to do this. Once you make the decision to buy a home, the second equally important decision is, how much home can you actually afford? The decision to buy a home is fundamentally different from the decision how much home to buy. And it's very important to know that when it comes to this question, there's some weird incentives at stake. The reality is, most people in the real estate industry, from real estate brokers and agents to mortgage brokers and mortgage sellers, they typically get paid on commission. Well, you should know that anytime somebody's getting paid on commission, they have an incentive to make the price of the thing go up because they're going to get a bigger chunk of money. So you're going to face a lot of pressure when you make that and say, okay, I'm going to buy a home. You're going to have everybody, real estate brokers, mortgage people, even friends and family, pushing you, get a little bit bigger house. You can afford a slightly nicer neighborhood. There's going to be a lot of pressure. And if you're not careful, you might do what we call in finance, you might buy too much house. Buying too much house is what occurs when you buy a home that is above what you can really accurately pay. And one of the biggest financial mistakes that people get into is they buy too much home. Okay, so if you make a decision to buy a house, congratulations, but then you got to make sure that you can buy the right amount of home, the right priced home based on your cash flow considerations. Now, fortunately, we have some tools. In previous lectures, I've told you that oftentimes lenders will apply certain criteria or certain metrics to you. Same thing here. Lenders generally use two ratios to determine if a homeowner is overextending themselves. In other words, these lenders, these banks, they'll use two ratios or two metrics to determine, hey, is this guy buying the house buying too much home? As always, once you know the metrics that they're going to apply to you, you can just apply them to yourself. Nice and easy. You can discipline yourself in the same way that a bank would discipline you. The two ratios that we're going to look at are the front end ratio and the back end ratio. The front end ratio is equal to your monthly PITI. We discussed PITI earlier. Your monthly PITI divided by your monthly gross income. In other words, how much money are you earning gross and how much is your PITI going to be? That ratio is called your front end ratio, and this is the magic number. It should be less than 28%. Okay, so that's your front end ratio. It should be less than 28%. If your monthly PITI as a fraction of your monthly gross income is above 28%, there should be some warning bells in your mind, because you might be saying, you know what, given my income, that may be just too much cash flow. Okay. The second ratio is known as your back end ratio. Your back end ratio, it's still talking about your monthly gross income, just like the first one, but now it's your monthly PITI and all of your other debt payments, car payments, student loan payments, any other payment, as we learned about in a previous lecture on consumer loans. So the back end ratio is your PITI and all of your other debt obligations as a function of your monthly gross income. And the magic number here, this should be less than 36%. Okay, so these are two ratios that banks and lenders will apply to you to see from their risk perspective if you're overextending. It's always a good idea when you know the metric that others will apply to you to beat them to the punch and apply the same metric to yourself. Okay, and there we go. So that, my friends, is the basics on buying a home. Now let's assume that you've gone through all the steps. You know that you're going to buy a home. You know where you want to live. You know how much home you can buy. You've got your cash flow set up and you're ready to go. Then you're going to have to get a mortgage. Okay, so the second part of our lecture, we're going to talk about mortgages. Now, in a previous lecture, we talked about loans. And we said that loans, or we called it credit and debt, same ideas. We had said that credit or debt, that they can be either open-end or closed-end. And we had said that open-end was credit cards or revolving credit, and closed-end credit referred to loans in a specific amount that are used for a specific purpose and have to be repaid in a specific way. That's what a mortgage is. So a mortgage is simply a home loan. That's all it is. A mortgage is the loan that you take out to buy the home. There's a couple of interesting things about it. The first thing, most loans require collateral. With a mortgage, the home that you're actually buying and taking the loan out for, the home is the collateral. So it's kind of weird to think that a mortgage is a loan where the item that you're buying is the collateral for the loan itself. But that's the way it works. The second thing to understand is that mortgages are amortized loans. And in a previous lecture, we covered the different types of loans. And I taught you about amortized loans. Amortized loans were also called declining balance loans. And they're also known as installment simple interest loans. This is, for most people, the most common type of loan that you'll take. It's what you'll take out for mortgages, for car loans, etc. Since we already went through that, we have a head start on this, and we don't have to go through the complicated steps again because we've done examples and we know the math, and we'll do a couple problems in a bit, but you already know how a loan behaves, and you especially know how amortized home loans behave, or I should say how amortized loans behave. So you understand a mortgage. Now, we're going to add a couple of things here to make our analysis a bit simpler and easier. First things first, whereas mortgages can either have fixed interest rates or variable interest rates, we're going to assume for now that the mortgages that we discuss in this lecture and in later discussions will have a fixed interest rate. This means that the interest rate that you secure on the loan when you take out the loan stays for the life of the loan. It doesn't change. That's a fixed interest rate. Now, in contrast, a variable interest rate can vary. And as time goes on, the variable interest rate can actually rise or fall. I'm going to recommend for now, as we start with basics, that we focus on a fixed interest rate. Because A, it's easier to analyze, but also think about this from the lens of a homeowner. If you get a loan with a fixed interest rate, this also means that for the life of the loan, which could be like 30 years, your monthly payment will also stay the same. So it's kind of a nice idea if you get a fixed mortgage, a fixed rate mortgage, because whatever the payment is that you calculate at the beginning, that payment's going to stay with you for the 30 years of the loan. And it's nice to have that predictability because that helps you plan out your cash flow. Now, the other big part when it comes to an amortized loan, remember, with an amortized loan, you're going to make a payment, and that payment, we just said, is going to be fixed. It's going to stay the same for the life of the loan. But critically, every payment that you make, so every month when you make your mortgage payment, remember the mortgage payment is going to cover some principal and some interest. Okay. Every mortgage payment will cover some principal and some interest. That's the first PI in your PITI. But the key to remember here is with each payment, a portion of the payment goes to principal and a portion goes to interest. Okay, we said that. Here's how you calculate it. The portion that goes to principal, actually, let's start with interest. The portion of your mortgage payment that goes to interest is calculated with the simple interest formula. Remember, interest equals PRT. And you basically multiply the mortgage's outstanding balance by the periodic interest rate. That's going to give you the interest component of the payment. Then once you have the interest component, you can figure out the principal allocation, the principal component. In other words, the part of your payment that will go to reduce your actual loan balance by attacking and reducing your principal. This is going to be equal to the monthly payment that you make minus the interest portion. So it's your payment minus the portion of the payment that goes to interest. So if hypothetically you make a $1,000 mortgage payment and 200 of those dollars went to interest, the remainder, 1,000 minus 200 or 800, will go toward the principal, reducing your loan balance by that amount. Now notice that since the principal repayment lowers your balance due on the loan, then next month's interest component will be even lower than this month's. Because again, and it kind of goes in a weird circle, but since the interest component is the outstanding balance times the rate, every month your outstanding balance goes down. So the interest component of your payment goes down, which means that the principal component of your payment goes up, and that process repeats itself in an accelerating cycle. Okay. So let's get back to some bigger level things on mortgages. When you're deciding on a mortgage, one of the big things you're going to have to understand is how much is this mortgage going to cost me every month? What's going to be my mortgage payment? And again, your mortgage payment is the P and the I, the principal and the interest in your PITI. It's going to be a big number. So you have to understand not only how big will it be, but what are the factors that will influence that? And the factors include three. Number one, the amount of money that you borrow. The higher your mortgage, the higher the payment. And the lower the mortgage, the lower the payment. Number two, the interest rate. Since the interest rate determines the interest component that you're paying, higher loan interest rates mean higher payments. Lower loan interest rates mean lower payments. Notice that we're going to revisit right here points. Because remember from before, if you pay for points up front, you're paying some upfront cash, but you're going to lower your interest rate, which will lower your monthly mortgage payment. And then the third concept, the third factor is the length of the loan. Now in America, typically, the average mortgage is a 30-year loan. But there are 10-year mortgages and 15-year mortgages and 20-year mortgages. So they can span multiple years, multiple terms. 30 is the default. But the basic idea is the longer the loan term is, the lower your payment because you're spreading it out over more time. The shorter your mortgage is, the higher your payment. Now, this is a subtle thing. This implies, well, if you want to lower your payment, then just get the longest loan possible. And that's correct. But remember, the longer your loan, the more interest you're going to pay as well. So once again, we have decisions and trade-offs. Okay, so those are the three factors. We did cover already the interest rates, but I just wanted to give you a quick hit on it with this slide. Remember, fixed rate mortgages, they have a fixed interest rate. It stays constant over the whole life of the loan. It never adjusts upward or downward. And because of this, these loans generate fixed, predictable, stable monthly payments. On the other hand, there's something called adjustable rate loans. These go by the term variable rate loans, or sometimes they call them ARMs, A-R-M, adjustable rate mortgage. With an adjustable rate loan, the interest rate that you pay for your mortgage, it can fluctuate. It's basically anchored to what's known as an index rate. There's lots of different index rates out there, but whatever the anchor interest rate is, if that anchor index rate changes, then your mortgage interest rate changes. And because the mortgage rate can fluctuate, so can your monthly payments. Now, this gets interesting. Generally speaking, ARMs offer lower interest rates than fixed rate mortgages. So a lot of people are tempted to say, I want to lower my costs. I'm going to get the ARM because the adjustable rate loan is less than the fixed rate loan. But that can be very dangerous. ARMs can, in fact, be very dangerous. If you're going to get an adjustable rate mortgage, the real question you have to ask yourself is, given my loan, how high can the interest rate and the subsequent monthly payment possibly go? If you're going to get an ARM, you have to think about the worst case scenario. What's the maximum rate that this interest rate can go to? What's the maximum monthly payment I'll have to make based on this rate? And given my own cash flow and liquidity, can I handle that situation? And if you don't think you can, then you've got to be real careful with an ARM, because the last thing that you want to happen is you're barely covering your mortgage at a certain rate, and then you have an adjustable rate loan, you're barely covering your mortgage payment, and then something happens where the index rate goes up, and therefore your ARM rate goes up, and therefore your monthly payment goes up. And now all of a sudden you've got a major liquidity problem, and that's not a good thing. Okay, so you have to be careful. So that's our fixed versus adjustable rate mortgages. Let's wrap this thing up by doing a little bit of mortgage math, and I'll use mortgage math to take you through a few other parts of mortgages. So you have to calculate, of course, how big is your payment going to be. And we're going to do some math to learn how to do that. There's basically three ways. Well, think about this. If you take out a loan, if you take out a mortgage, you're going to be paying back money every month. That's an annuity. So we can think about these mortgages as effectively annuities. And that means that there's a few different ways that we can solve them. There's three ways. You can solve a mortgage calculation problem with a mortgage factor table. You can use the monthly payment formula. And of course, you can go to our old standby, nice free online calculators. And calculators online are great because not only are they easier to use, but on top of the payment amount, they also provide for you a nice little amortization table that helps you see just how the loan will behave over the 30 years that you have it. So let's go into it, and let's just talk about a few here. So case study number one, we're going to calculate our mortgage payment. So let's say that you take out a 30-year mortgage for $180,000 at 6% interest. How big will your monthly payment be? And we're going to start by using what's called a mortgage rate factor table. This is not the same as the TVM tables we had before, but it behaves in a similar way. So if you look at this slide, This right here, my friends, is a mortgage rate factor table. If you look across the top, you see the term of the loan, the length of the mortgage, 30, 20, and 15 years. And if you go down this column, you see the interest rate for the mortgage. Let's say that hypothetically you have a 20-year mortgage at, I don't know, we'll say 5%. 20-year is right here. 5% is right there. This magic number, 6.60. So for a 20-year, 5% mortgage, your factor, your magic number is 6.60. What does this mean? The number 6.60, or really any of these numbers in the factor table, is for every $1,000 in mortgage, that's how much you're paying. So for a 20-year, 5% mortgage, your factor number, your magic number is 6.60. This means that for every $1,000 of mortgage that you take out, you're going to have a $6.60 monthly payment. Obviously, you're taking out a much bigger loan than that. So you simply then multiply it through, and that's how you get the payment. Okay, so let's do an example. Let me clean this up. And let's just do an example, and it'll make some sense. We'll get that math down nice and easy. So you're going to take out a 30-year mortgage, 30-year, at 6%, and it's going to be for $180,000. How big is your payment going to be? Well, it's very easy. We know it's a 30-year loan. So let's go to 30 years. And we know it's going to be 6%. So let's go to 6%. And in this one, our magic number is 6.00. What this means, my friend, is that for every $1,000 of mortgage, you're going to be paying $6.00 of payment. So it's like a ratio. But you're not taking out a $1,000 mortgage, you're taking out a $180,000 mortgage. So you just do a little equating and a cross multiplying. If every $1,000 of mortgage cost you $6 in payment, then $180,000 in mortgage will cost you what in payment? And you simply cross multiply, you solve for PMT, and you're going to get right there $1,080. There it is. So $1,080, you use the table, it's nice and easy. Okay, so that is how you use the table. Let me clean this up because I want to also show you. I like the tables a lot because the tables also help you do something very interesting. We solved how big your we solved how, let me take that back. If I gave you the timeline, the mortgage amount, and the interest rate, we can solve for your payment. We just did that. But look at how you can also use this mortgage table. Suppose that you say, hey, Eric, I've done my numbers and I know that I can actually afford $1,300 in payment every month. Then you ask the question, how big a mortgage can I take out? That's a great question. Because again, up here when I first started this question, we assumed how big the mortgage would be. But it's really a smarter move to say, hey, given my cash flow, I know what my PMT can be. So look what we can do. Once again, given this, we know that our factor is 6.00. So if you can afford a monthly payment of 13, well, With the factor of 6.00, this means that every $1,000 of mortgage requires $6 of payment. Well, now we're going to solve for what size mortgage you can take out, given the fact that we know that you can take out, that you can handle a $1,300 payment. You cross multiply that way, you solve for your mortgage, and you'll see that you can take out a $216,667 mortgage. So it's a great tool because in real life, you're not going to say, what's my payment for this mortgage? You're going to say, if I can afford this much payment, what size mortgage can I get? And look at the next question. So we know that that mortgage we can take out in this case is $216,667. Well, we can also then ask, if I'm going to put down 20%, how much house can I buy? And basically, if you then take the mortgage amount and divide it by 0.80, remember, if you're putting 20% down, then your mortgage is only 80% of the home's value. You take your mortgage amount, divide it by 80%, and that's going to give you $270,833. And that, my friends, is the maximum house that you can afford. So we've got some really cool tools that will help you to make sense of how to decide how much house you can afford and not buy too much house. So let's go back to this. That was case one. This is with the factor table, and we got that there. Case one again, we can also use the monthly payment formula. Now, this is a bit harder because you got to do the math, but you can still do it. The monthly payment formula is this right here is the formula for the monthly payment. Now, in this case, P is the size of the loan. It's the principal, the initial principal. R is the interest rate. Now, this is very important. We know that the rate is 6% or 0.06, but that's annual. Since this is a monthly payment, we have to take 0.06 divided by 12, and that's 0.005. So that's our R. Since it's the APR on a mortgage is the annual rate, but since we're talking about the monthly period, we have to adjust by dividing the interest rate by 12. Okay, and the same thing. We know that N is the number of payments. Now, it's a 30-year mortgage, but since you're paying monthly, it's going to be 30 years times 12, or 360. So notice that we had to adjust the payments up by a factor of 12, but we had to pull the interest rate down by that same factor to account for the monthly as opposed to annual payments. Now, this is a bit of a bear, but if you were to plug numbers in, it would look something like this. It's going to be equal to 180,000 times 0.005 times 1.005 to the 360 over 1.005 to the 360 minus 1. This would be 180,000. And if you do the math, you would get 0.0301129 divided by 5.022575. That's 180,000 multiplied by 0.0059955. And that would come out to 1079.19, which, given rounding errors, is the 1080 that we found up here. Where did we go? We had it up here. That was 1080. Okay. So there you go. The final way to do it is with our old friend, the calculator. Now, actually, let's go back here. Let's get ourselves organized. We know with the calculator, we have to do our little organizer, present value, future value, NI, and PMT. We know that our present value is going to be the 180,000. Our future value is going to be 0 because we're going to amortize the loan and kill it off. The N is going to be 360. Notice that this is 12 payments a year times 30 years. Now the I, before with the formula, we adjusted it. The I is going to be 6%, and I'll show you something right now. And the PMT is what we're solving for. So we go back to our old friend, financial calculator, and this is a great one right here. We could do it with this, but if you go to this calculator.net site and you actually go to the financial tab, you're going to get this, a whole list of calculators. Press mortgage calculator, and it's sort of the same thing. This one's great because this gives you a whole slew of other things. So you can add in property taxes, insurance taxes, PMIs, HOAs, all the stuff that we discussed, you can add in. We're not going to do that right now. We're going to keep it really simple. So our price, I believe we said, was 180,000. So let's show the keyboard. 180. We're making 0 down payment because that's just, oops, this fixed right here. We're not putting anything down because, well, technically the mortgage is 180. So you just set 180 and leave the down at 0. The loan term is going to be 30 years. And the interest rate we said was going to be 6%. And we calculate that. And there we go, right there, 1079.19. So if we use the calculator, we once again solve for a PMT of 1079.19. Good stuff. The beauty of the calculator, besides being very easy, is that we can answer 2 other questions. So watch this. The calculator tells you up on top, monthly payment, that's that green bar right there at the top, monthly payment, 1079.19. And if you look under it, it tells you that you're going to make a total of $388,508 in payments. If you're paying $180,000, but you're going to be paying $388,508 in total payments, this also gives you a handy dandy line that tells you just how much interest you're going to have to pay. And you might be shocked to see that you're going to spend more on interest than you're going to spend on the actual cost of the home. Okay. The other good thing, look at this amortization schedule. It defaults to annual. Click monthly. And look what it does. It tells you month by month by month for the entire ownership window here of your payment, which again is going to be 1079.19, how much goes to interest and how much goes to principal. And as we discussed in an earlier slide in the presentation, look at the interest column. Every month, less and less and less and less of your payment goes toward interest. And therefore, every month, more and more and more goes to principal. This accelerates you paying down the loan. Here's a very interesting, tricky, and when you have a mortgage, very frustrating question. You have a 30-year loan. How long do you think it would take for that loan balance to be cut in half? Most people would say, well, you know, it's a 30-year loan. You divide that by 2. In 15 years, it's cut in half. Watch this. Look at this column that says ending balance, and we're going to have to scroll. If the loan is 180,000, we need to find where that becomes 90,000. Look at this. 15 years in, after 15 years, here at payment 192, no, actually, no, that would be payment 180. After 15 years, you still owe $127,000. You're halfway through the loan term and not even close to halfway of paying it off. Instead, to get your balance down to 90,000, it goes up to your 252nd payment. It takes you 21 years to pay that loan off in half. Sorry, I'll rephrase. It takes you 21 years to pay off half the loan. Notice that if it takes you 21 years to pay off the first half of the loan, that means that it only takes you 9 years to pay off the second half. And the answer, the reason for that is because, again, the loan slides over time and more and more and more and more goes to principal. Okay, so that's your mortgage payment. We know what points are. We'll go through it again with some math. We know that points are a fee that you pay. And when you pay a fee, when you pay a point, you get a lower, when you pay a point up front, you get a lower interest rate. In fact, the more points you pay, the lower your rate goes. And the lower your rate goes, the lower your monthly payment goes. So the basic rule is, if you pay more points, you get a lower payment. Points are defined technically as 1% of the mortgage amount. So 1 point is 1% of the mortgage amount. And again, you have to pay these off in cash when you close. Now, because you're paying money up front in exchange for a lower payment later, the decision, because it's all about decisions, right? The decision to buy points is a break-even decision. And let's do it with some basic math. Suppose that a lender, so you go to look for a mortgage, you want to get a $200,000 mortgage and you want to get it over 30 years. Your lender offers you option A, the regular mortgage at 7.5%. Or your lender says, option B, I can give you, he says, a 7% rate if you buy 1.75 points. So how do you make that decision? Well, here it goes. For option A, we're going to make it very simple. For option A, 30-year, 7.5%, 200,000. If you were to go back to the factor table that we showed earlier, the factor here is going to be 6.99. And therefore, that means that for every $1,000 of mortgage, you're paying $6.99 in payment, but you're getting $200,000 in mortgage. So what's your payment? And if you cross multiply, your payment will be basically $13.98 per month. Let's do the same thing with option B. In this case, in option B, you're still taking out $200,000 at 30 years, but now you're paying 7%, so it's a lower rate. 30-year 7% has a factor of 6.65. So in this case, I'll do it across to save some room, $1,000 mortgage cost you $6.65 in payment, but you're going to get a $200,000 mortgage. So what's your payment? And if you solve for it here, your payment is $13.30 per month. So then, how do you decide to do it? Well, think of it this way. Since you're buying 1.75 points, 1.75 times 200,000 equals $3,500. Again, that's how much these points cost you. Remember, 1 point is 1% of the mortgage price. So 1.75 is 1.75% of the mortgage. That's 1.75 times 200,000. It's basically going to be $3,500 in points. So here's what we're looking at. You're being asked to spend $3,500 up front. What are you getting out of it? Well, without the points, you're spending $1,398 a month. With the points, you're spending $1,330. So basically, these points would save you $68 a month in savings. So here's the ultimate question. Should you do it? The question is, should you spend $3,500 to save $68 a month? And the way that you answer that is you just divide 3,500 by 68. You're going to get 51.4, and that's your break even. If you expect to stay in that house for 51 months or longer, then you take the points. Because at 51 months, that's where the break-even crossover happens. And beyond that, you're saving more money than you're paid for the points. If you're thinking about flipping this house or turning and burning it, and you're going to be in it for less than 51 months, don't take the points. So that's points. A similar idea to points is the idea of a refi. I had mentioned before that mortgage rates can fluctuate. Well, sometimes imagine that you got a loan when mortgage rates were 7%. And you're paying 7%, but then something happens in the macro economy and interest rates fall down to 5%. And you say, well, this sucks because I'm paying 7% and new loans are 5%. Well, you can fix that by getting a refi. A mortgage refinance basically means that you're taking out a new mortgage in an amount equal to your existing balance, and you're using the proceeds to pay off your old loan. In other words, what you're doing is you're going to take out a new loan at the lower interest rate, use those proceeds to pay off your old loan at the higher rate, and that adjusts your payment down. This is a popular move, very common, and a very smart move at times. But the big thing to remember is a refi, it is a new loan, so there's new loan closing costs. So once again, it's a break even. In this case, the refi decision is it's a trade-off between the lower monthly payments and the new closing costs. So once again, it's a break even analysis. Let's do a quick piece of math on this, and then we'll be set. Suppose that you currently have a $200,000 30-year loan at 6%. You see that rates have fallen to 5%. So rates have gone from 6% down to 5%. You're considering a refi. To do a refi would cost you $2,500. Should you do it? Well, let's go through this. Case one, at 6%, 30-year, your factor is equal to, let me get to this one right here. Your factor, sorry, I'm on the wrong page. Your factor is equal to 6.00. I won't go through the math again, but this means that your payment is going to be equal to $1,200 a month. On the other hand, at the lower rate of 5%, so at 5% 30-year, your factor here is going to be 5.37. And therefore, your PMT will be $1,074 a month. Well, you know where we're going with this. It's going to cost you $2,500 to do this. And if you do it, you're going to save $1,200 minus $1,074 equals $126 a month. So the question is, Would you spend $2,500 to save $126? And the answer is it depends. You simply take 2,500, divide it by 126, and you're going to get 19.84, which I'll say is basically 20 months. If you're going to stay in the house for an additional 20 months, there you go. It's worthwhile for you. On the other hand, if you plan on leaving the house in less than 20 months, don't do the refi because you won't be in long enough to save enough money on the payments to offset the cost of the loan. Always a break even, methodical decision making, okay? And that's our third case study. And finally, let's just talk about this other idea called a home equity loan. We know that you can take out a mortgage on your home. Well, you take out a mortgage to buy a home. But it's also possible once you have enough equity built into your home where you can take out what's known as a HELO, a home equity loan or a home equity line of credit. These are basically loans that homeowners can take out against the value in their house. So suppose that you have a home, you've owned it for 10 years, you've made payments, and now the house has gone up in value. So you still have a bit of a mortgage, but now you have more in value than the mortgage. So you've got what's called equity, okay? Just so you know, your equity in a home is equal to the home's current value minus your home's mortgage balance. Obviously, over time, two things happen. In general, the value of the home goes up and your mortgage balance goes down. So over time, you have more and more equity in your home. A home equity line of credit or a home equity loan is basically a loan that you can take out on that equity. The house is, again, the collateral. Now, there's some subtlety. Generally speaking, the home equity loan is a lump sum thing. And a HELO, the line of credit, is like a revolving credit card, open-ended thing. But don't worry about that for now. The big idea here is you can take out loans against your home's equity. The question then is, how much loan can you take? And to understand this, lenders will determine your HELO capacity by using a tool called the CLTV, the Combined Loan to Value Ratio. And we can solve this with a quick example. So your home is valued at $300,000. So your home has a value of $300,000. Your mortgage balance is $150,000. Notice this is probably not the size of the mortgage that you took out. You've been paying this thing for a number of years, so your value's gone up and your mortgage balance has gone down. And let's say that your bank or your lender offers a CLTV of 80%. Question is, how much HELO can you take out? And it works like this. Step one, $300,000 value times 80% is $240,000. That's the basis that you'd be eligible for. You then take that and you subtract your existing balance on your mortgage. And that resulting number, 90,000, that's how big a HELO you can take. So again, the value of the home and the lender's CLTV give you the basis that you can have, and then your existing mortgage balance is subtracted from that, and the leftover number, that's your HELO capacity. And that's how a home equity line of credit works. Okay. That's basically it. There's a couple of other small little things, and I just want to show them real quick. Most mortgages take 30 years to pay off, but a lot of people are tempted to pay their mortgage off early. It's generally, if you can afford the cash flow, it's a good move. Once again, though, paying off your mortgage early, it feels good psychologically because your debt's gone, but there is a trade-off. Because when you're paying off a mortgage early, you're making a trade-off between the interest expenses that you would have paid on your loan. So you're saving interest expenses, but in the short term, you're sacrificing cash right now. So think about this. If you have 10 more years on your mortgage and you pay it off now, you're gaining the interest savings in those 10 years. But you're losing all the cash right now that you're paying it off with, and you're losing the opportunity cost of what that cash could do later. Okay. But if you decide to do it, there's a couple of strategies. Number one, don't buy too much house. It's always going to be easier to pay off a smaller mortgage with a house that you can afford. So just keep your house reasonable to begin with. Number two, understand and use points, and use points judiciously to lower your payment. But the big idea behind paying off your mortgage early is what I call attack the principal. And the idea here is, if you want to pay your mortgage off early, anytime you get a little bit of extra money, you get a work bonus, you get a big tax refund, or every month you add a little bit of extra to your payment, you attack the principal. Let me show you how it pans out. Let's go back to this thing right here. This was the one that we just showed, $180,000 mortgage. Let's say that you've been paying this thing off for 5 years. And at the end of year 5, right there, you still owe $167,000. Okay. Now let's say that you get at work a $20,000 bonus at work. Now a part of you is saying, let's go to Vegas. Let's buy some new clothes. But future you says, hey, why not think about your mortgage? So let's say, again, you currently owe $167,498. It's the end of your 5th year. You get a $20,000 bonus at work. And instead of going to Vegas, you write a check to your mortgage company and you say, dear mortgage company, please see the attached check for $20,000. I direct you to apply this full $20,000 to my principal. Now look what happens. That reduces your principal from $167,000 to $147,000. Look at this. To get your principal to $147,000 takes you basically down to the end of year 11. By sending in that extra $20,000, you effectively fast forwarded yourself 6 years into the future. You just knocked 6 years off your mortgage. So always attack the principal. You can do it by sending in what I call found money, your tax refund. If somebody passes and you get an inheritance, if you get a big work bonus, you can even just make a little bit of an extra payment every month. So if your payment was $1,900, send in $2,100. There's lots of ways to do it, but by attacking the principal, you fast forward the loan reduction. Finally, there's a couple of other tools here. One of them is called a reverse mortgage. With the reverse mortgage, older people, you have to be 62 or older to do it, but older people can borrow against their home's equity. The key to understanding a reverse mortgage is understanding 2 things. Number one, understanding that a home is illiquid. So what a reverse mortgage does is it allows an older person, usually in retirement, to borrow money against their home right now and get the cash. So a reverse mortgage is sort of a tool to transfer an illiquid asset into liquidity. You're basically taking cash out of the house, so you're taking this illiquid asset and generating liquidity with it. Now you're saying, well, Eric, that's just like the HELOC. What's the big deal? The other second thing is this. It's the way that you pay it back. And with the HELOC, you pay the money back as you have the house. With the reverse mortgage, in general, either when you as the homeowner move, or to put it bluntly, more commonly, when you die, the home is sold, the proceeds go toward the loan repayment, and whatever's left over goes to your estate. So this is a great tool for people who have a lot of illiquid asset and they need liquidity. Now, there's a trade-off. In part, the trade-off is your beneficiaries won't get as much home or inheritance, but for some people, that's okay. But that's the key here. You take out the loan now, you spend the money any way you want, and then when you either move or more likely die, the home is sold, the proceeds go to pay off the reverse mortgage loan, and the difference goes to your beneficiaries. Okay. And then the other thing, we have two other types of loans, both of which I do not recommend: balloon mortgages and negative amortization loans. They're called NEGAMs. With a balloon mortgage, you're taking out a loan for the full value of the house. And instead of making monthly payments over 30 years, you make no monthly payments, or maybe really low monthly payments for a short window of like 5 to 7 years. But once that period ends, you're required to pay the loan off in full with one big lump payment. Now, you might be asking, why on earth would I do this? Some people do it because they think that interest rates are going to fall. So they figure, I'll take out a loan right now, I won't make any payments, I'll bank all my cash, and then in 5 or 7 years, when interest rates fall, I'll just roll the loan over. You roll the balloon forward by taking out a new loan to pay off the old loan. Well, this sounds fine and dandy until interest rates go up, in which case you now have to take out a loan at a much higher interest rate and you're going to get really hurt. The second type of mortgage, another one that's really dangerous, is called a negative amortization. A negative amortization has the benefit of having really, really low payments. In fact, with a neg-am, or a negative amortization loan, the payments are so little that they don't even cover the full interest. And therefore, as a result, with a neg-am mortgage, your balance on the loan does not fall every month. It actually goes up every month. In other words, you're accepting a really, really, really low payment, an artificially low payment. It's so low, in fact, that it's not covering all the interest, and the unpaid portion every month gets added onto your loan balance. So over time, you owe more on the house. Okay, these are both other terms that you need to know. I would not recommend them, but I want you to know what they mean. Okay, hope you have a great day. Thanks for your time, and I'll see you next time.